Some of the biggest names in tech, from Microsoft to Meta and Apple, reported earnings. We take a deeper dive into the results and get expert analysis, plus a look at the implications for the broader market.
Amazon topping estimates for the fourth quarter earnings and revenue, but it did issue disappointing guidance for the first quarter, and that's a big reason why you're looking at shares off nearly 3% so far in early trading. The tech giant expecting a hit from FX rates. Joining me now, we want to bring in John Blackledge. He is the TD Cowen's Managing Director and Senior Equity Research Analyst. It's great to have you here, John. Let's talk about some of the commentary that we got out from Jassy on the call last night. A lot of it was focused, or some of it was focused on the AI spending plans, what exactly that looks like. I think that eye-popping number, just over $100 billion, might have been a bit of a surprise here to the street. But I think also just in terms of their ability to keep up with AI demand. What was your big takeaway?
Yeah, so they did guide to 100 billion-ish in CapEx, and that would be up a little over $22 billion versus 24. And they said the vast majority would go to AWS and the AI infrastructure build out. And we were at 95 billion in total CapEx. Sell side consensus was 84 billion. So it was a bit above the sell side consensus. We were kind of there. I also felt investors were around 95 billion. So not, it was above, but not, and I think people were bracing for it with the Meta results and Alphabet results. And to your question on the capacity constraints, yeah, I mean, CEO Jassy said, listen, like, we think AWS revenue growth would have been better absent the capacity constraints. That was also consistent from, kind of from what we heard from Microsoft and Google. And he said, with the capacity that they're going to bring online, it should be alleviated by the back half of the year. So that should be good as we round through the year for AWS revenue growth. And then he also said, like, we are making these investments. And historically, when we've done this and accelerated spend, there's revenue opportunity on the other side of it. And he called out that the AWS generative AI revenue is running in kind of like the multi-billion-dollar range, growing triple digits.
So then is the stock reaction today a bit of an overreaction?
Yeah, I mean, it's been a good start to the year. And just around the edges, and then you even referenced it, CapEx was a little bit higher. So, investors' CapEx, sell-side CapEx goes up. 1Q guide, the revenue guide was a little bit light at the high end relative to sell-side consensus. And you mentioned the FX drag and the leap year drag. And then the operating income guide was also a touch light. But I mean, all in, it was a pretty solid quarter. 4Q beat on revenue and crushed on op income, and so all in fine. So it's down a couple percent today. Let investors regroup, and it should still be a really good year for Amazon shares.
John, where does Amazon sit in your coverage list? I believe you also cover Meta is one of the names that you cover, and I believe Alphabet. How are they positioned relative to those two?
Yes, yeah, we cover Amazon, Alphabet, Meta, Netflix. Amazon was our top pick going into 2025. And some of the reasons were, kind of strong AWS revenue growth. Second was continued margin expansion. And we actually, off of earnings last night, we raised our margin estimates and our operating income estimates. And then the third point, which we haven't really layered in before, in one of the parts of the thesis, is that we have free cash flow growing over 50% in 2025. And we just talked about this massive, kind of increase in CapEx over the last couple of years. Despite that, we have CapEx over 50%, and that's due to the ramping margins that we've seen at the company, led by AWS, which posted a 40% margin ex one-time item in 4Q. Their advertising business growing high teens, super high margin.
Amazon rounding out a week of big tech earnings, reporting a strong holiday quarter, but disappointing investors with its outlook for the current quarter. The company also announcing plans to boost CapEx to just around $100 billion this year, largely due to AI investments. This coming after Google and Microsoft also announced plans to spend billions on AI. Joining me now, we want to bring in Tony Wong. He's T. Rowe Price Science and Technology Equity Strategy Portfolio Manager. So Tony, we just got the analyst side of the read that we've heard from big tech so far. I'm curious, just from a portfolio manager perspective, did it live up to those expectations and put to rest some of those valuation concerns?
Hey, well, you look at Amazon and think more long term, there's a few things that are really going well for the company, and they're kind of happening at the same time. So, one, retail margins and kind of that utilization of their infrastructure for e-commerce is getting better. So, you see that kind of march up quarter over quarter. And especially if we get a healthier consumer, that flywheel of like same day, next day should be improving and expanding operating margins and EBIT. So I think that's one. Number two, like AWS continues to grow pretty well. That 19% at that scale is impressive. And especially we get more AI tailwinds and they get more capacity. That's the second good driver. And then the third, I would say, is ads. Like that's a really high margin, high growth business. So when you have like those three things kind of all working well, I think that this sets up well for the longer term. In addition, I think when you think about where Amazon is and their kind of business, it's pretty. It sets up a good industry dynamic where they can perhaps like achieve better synergies with AI and robotics. So I'm really looking forward to hearing more about their chip strategy, how they differentiate themselves versus other clouds, and then how they integrate robotics and kind of drive further efficiencies and pass that kind of cost saving to the consumer.
So it sounds like you think some of the valuations here for big tech are justified following these results.
I think you have to go, kind of stock by stock. Big tech has done pretty well over the last few months, and Amazon's been up a lot over the last quarter. So, I think that you're always going to have some price adjustments, but over the long term, I think you look at like the type of returns that Amazon can earn, and at this scale, like I definitely view it's set up well, especially if like large language models get easier to deploy. The tech proliferates. That's probably good for their cloud. In addition, like maybe you don't need to kind of own the frontier model in order to benefit from it. And especially a lot of the open source dynamics kind of help be a tailwind. And Amazon can really plug that in across their, kind of large ecosystem of businesses. So, to me, like when you think about what you need to win in AI, it's probably scale, compute, AI talent, large customer base, good, a lot of data. And, there's a lot of ways that Amazon's well positioned.
Tony, I'm curious how you've been looking at the commentary that we've been getting from big tech CEOs in regards to DeepSeek. And that was very much has been one of the focuses here or maybe of interest for so many investors and analysts here over the last week or so following the revelation and the headlines surrounding DeepSeek. And I think overall, they've been very positive. We heard Mark Zuckerberg talking about the fact that this almost reinforces some of their spending plans going forward. Microsoft CEO Satya Nadella has also been very complimentary of DeepSeek. I'm curious, how do you see that impacting not only big tech, but maybe does it open the door for more investment opportunity beyond the Mag 7 when it comes to tech?
Yeah, I think that's a great question. A lot to, we're still learning about a lot of this. But, the way I see is that, tech, the evolution of tech is always to drive down costs and increase adoption. And I think that definitely is good for the long term. A few months ago, everyone was debating is there ROI in AI? And, here with costs coming down dramatically, potentially in some ways, you can kind of say that is bullish now. I think that this will definitely help proliferation of the technology of LLMs. And, I think there is this like kind of, debate of like who benefits the most. And I do think that in some ways this opens up other players that were maybe subscale or too small, or maybe the apps were just too expensive to develop, that this opens the door for more innovation. And as a result, like, you could see a new kind of crop of companies that kind of do well behind this. And you're also seeing like the app layer really kind of inflect here. I think you saw Palantir earnings recently, and that just shows like a really nice inflection at the app layer, app loving over the last 6 months as well. So as kind of AI gets easier, more ubiquitous, you could see then, stuff outside of the Mag 7 do well as well.
How about the AI networking side of it? Are there some plays there when you take a look at Sienna, when you take a look at maybe Coherent, just in terms of the fact that they could then leverage off of this and the wider adoption?
Absolutely. So, you think about like where we're going with frontier models, like you want to pretty much cluster as many of them as you can, these GPUs or custom silicon. And kind of the more you cluster them, the harder it gets, though, because a lot of times you need higher quality interconnects for the model not to like stall or break down. And so, I think that the networking aspect of it is definitely where a bottleneck is in terms of delivering AI infrastructure. So, I think that those stocks I've seen have done well. They're probably well positioned, and we're going to need to see a lot more innovation at that layer.
All right, Tony, always great to get your insight. Thanks so much. Have a good weekend.
We've been hearing from all the big cloud players on earnings calls, and investors are disappointed with the results. Amazon, the latest with Amazon Web Services revenue coming in light for the fourth quarter. For more, we're bringing in Ben Beharin, CEO and Principal Analyst at Creative Strategies. Ben, always great to have you on the show. So we have heard, Ben, from the big cloud giants, Amazon, Alphabet, Microsoft, and there did seem to be some disappointment, Ben. You look at Amazon, AWS sales showed no acceleration there. It seemed to echo the results we saw from Microsoft and Google Clouds. What is going on there, Ben?
Yeah, I think there's a couple dynamics that we can interpret from this. I think we get lost with this idea that, a lot of this increased spend in the cloud is coming from AI, and there's part of that, which I'll get to in a second. But I think we forget that there's a lot of general purpose cloud that is still out there. And I think we saw a lot of strength in that spending. That's just, again, enterprises needing to bring their workflows from the cloud. Most estimates have that most large enterprises have 40% or less of their workflows on the cloud. So there's still a long on-ramp of just getting traditional enterprises to move basic workflows, again, we'll say general purpose workflows, to the cloud. And then you have the AI side of this. And I think where we saw a lot of the growth in that spending was, we know many organizations are out there training and deploying and doing these pilot projects for AI across their enterprise, but they're deploying those to a small fraction of their enterprise while they're doing these pilots. So we haven't seen that spend happen yet, and I think we're seeing a little bit of a pause of that, which is the result of we as an enterprise or the market segment has gone and done those pilots, and now they're waiting to mass deploy, and we think that's what's going to happen in the second half of this year.
So your bottom line, Ben, what you're arguing is the AI cloud rollout is still early, and you're betting on better prospects ahead second half of 25?
Yeah, and I think that's, again, just predicated on, all of these organizations who are doing these AI projects, whether that's in customer service or whether that's in automating a whole slew of their broad tasks from marketing to finance, engineering. That's not deployed at 100% of the enterprise. In fact, it's probably 10% on less on average. So we're waiting for that ramp. And I think that spending happens in the second half of this year. I think that's what most CIO, CTO surveys are suggesting, is that's when that money will deploy. So we're kind of in this little bit of a gap, like I said, where we're still in project phase, piloting phase. We haven't moved to deployment, and we're not seeing that scale yet like I think we will in the second half.
It was interesting, because when you listen to these big cloud giants, they talked about capacity constraints. So I guess that suggests, listen, we're just having a hard time getting our hands on enough data centers, hardware, chips, networking gear. What does that tell you about potentially big tech CapEx plans for the rest of this year and maybe into 26?
Yeah, I think you continue to see them commit to larger CapEx spending. I think, an interesting analysis is just look at how historically Amazon in particular, but you can tie some of this to sales, how the hyperscalers have actually seen direct correlation to CapEx spends to an increase in sales, increases in revenue. That's been a correlator for Amazon for almost 10 years now. So I think we'll continue to see that. They're justifying that CapEx spend. We still anticipate that they'll continue to spend that because, again, we are still selling a small percent of AI servers, whatever we want to classify in the AI server infrastructure, as a part of the general purpose spend. There's still a massive amount of data center infrastructure that's got to get converted into new AI infrastructure. And again, that doesn't take away from the fact that we're still selling and shipping general purpose servers. This is additive. This doesn't take away from those general purpose services. So there's a long ramp of growth here. I think we'll remain compute constrained, and that's what the race is on for. And when you hear really all the CEOs of these companies, they're saying, right, this is a once in a lifetime opportunity. We need to spend so that we get the portion of this market share. They know they're competing for that, and they're going to be at a shortage of infrastructure, which, if anything, should continue to convince us all that there's still a long roadmap of silicon and infrastructure spend, despite the negativity that the market sees there.
So is one read-through, Ben, is what you're suggesting there, if I'm a viewer right now and I'm invested in NVIDIA, do I have a smile on my face?
Yeah, I mean, I think, again, they're well positioned. They're still going to be the primary beneficiary of the vast majority of this CapEx spend. You have people out there thinking they could double revenue this year. I'm not that optimistic. I think they'll do better, right, than 2024. But there again, we're going to remain compute constrained because AI innovation, and you see this, like DeepSeek, again, didn't do anything to change the thesis that scaling laws still exist and will demand more compute, not less, as we bring inference costs down. And AI is outpacing our hardware compute, and that's not going to change. In fact, we probably have a long, many-year roadmap where the pace of AI software will outstrip compute. So this is a long growth cycle. I think there's a lot of technical nuances to this that just get misunderstood, which is why I think the market does what it was. But the demand is not slowing. Compute needs are going up, and that's not changing anytime soon.
Ben, always great to see you. Always great to have you on the show. Thanks for joining us.
Yep. Thanks for having me, Josh. Have a good one.
Number of chip makers are starting off the trading day in the green here this morning, just 2 weeks after a low-cost AI model from Chinese startup DeepSeek did roil stocks with fears of overblown AI spend. Joining us now to break it all down and what this ultimately means for your portfolio, we want to bring in Ivana Delevska. She's a Spear Invest founder and chief investment officer. Ivana, it's great to have you back here on Yahoo Finance. So talk to us just about, here we are coming off a number of the reports that we got from some of the Mag 7 companies, very much doubling down on their plans to spend big on AI. The market very much seems to be not taking too much issue with that. So what does that signal in terms of the growth opportunity that's ahead?
Well, Shana, thanks for having me. What we saw last week from the hyperscalers in terms of CapEx is some really blowout numbers that the market wasn't expecting before. So going into this year, the market was expecting about 20% growth after a very strong year last year, and now that's looking closer to 40+%, which is pretty significant. And really, if you look at the companies that are going to be affected, it's really a handful, up to 10 companies, right, that are benefiting from this CapEx spend. So it's going to be a meaningful increase to earnings estimates as we look to the rest of this year.
What do you think it ultimately means for NVIDIA? It was a stock that was hit extremely hard on the heels of the DeepSeek developments, and then here we are 2 weeks later, and it's a very different narrative shaping that stock.
Well, first of all, we think the DeepSeek announcement in itself was a pretty positive development for NVIDIA. So the market completely misinterpreted this to begin with. I think it may be negative for some of the other companies in the value chain, like open source models, but for companies that are making hardware, more innovation is always by definition better. So we think that was an amazing entry point to pick up some of these hardware stocks. And then on the flip side, you have now these announcements in terms of CapEx and companies doubling down and growing. We think it's a really good setup for NVIDIA specifically and broadly the hardware value chain.
So the recent selling activity, I guess, would you be a buyer then still at these levels?
Absolutely, and not just NVIDIA. I think across the value chain, you saw energy stocks like power generation stocks go down 20% on the announcement. You saw networking plays as well go down 20+% on the announcement. So we're finding opportunities across the board.
Do you think DeepSeek, the worry very much was overblown, to put it in your words, but in terms of a worry of the past, I guess, how much is the market still grappling with maybe the fallout when it comes to some of those names that you mentioned that might be hit more significantly versus the fact that it will also act as this catalyst, more broadly speaking, for the AI adoption trade?
Well, I think it's going to be interesting to see. I think as we go forward this year, you're going to see companies like Cloudflare we saw last week where they said, look, cheap models are actually very good for us, right? So we're able to offer these cheap models to our customers and they can build applications on top of them. So as you see more of this come to market and more companies speak about the positive effect of DeepSeek rather than the negative, I think you're going to start seeing valuation reflect that narrative.
One of the themes that we've been talking to a number of guests here, especially over the last 2 weeks, is this theme around AI networks and how this is the next opportunity when you're looking to capitalize on that next phase of growth within the AI spend. Arista Networks, I believe, is one of the stocks that you like within that space. Why are they so well positioned compared to some of the others?
Well, what we're going to see going forward is that a lot of the innovation over the past 2 years came from the actual chip. So NVIDIA brought to market differentiated chips that are able to do something that prior generations weren't able to do before. As we look forward, a lot of the improvement will come from how you connect these chips together. And this is where networking comes in place. So companies like Arista Networks is really well positioned to benefit because they've been on the forefront of innovation on the networking side. So as we see this broaden out to the rest of the value chain, I think networking is one of the more interesting areas. Memory is another area. Those companies are a little more different business models where they haven't historically generated returns on invested capital the same way that Arista has. So I think there is broad set of opportunities. Networking is one of the more interesting ones.
Nirvana, there was a headline out this morning. It was an exclusive report from Reuters talking about OpenAI set to finalize their first custom chip design this year. Of course, that would reduce their reliance on NVIDIA. I'm curious, what do you see as the broader implications of that?
So custom chips is one of the more interesting investment opportunities for the next 2 to 3 years. We're seeing companies like Amazon come up with their own chip. Microsoft will be coming out next year. So all of these companies are coming up with their own in-house chips. What I would say is that NVIDIA, what they offer is not only the chip side, but frameworks and software on top of the chip. So if you're a tech giant, you may be able to use your own chip. If you're anybody else that could benefit from these frameworks, like anybody developing robotics applications, medical applications, basically anywhere where you need to use some of the software that is pre-built, you are going to be more inclined to use NVIDIA chips. So it's two different markets. I think there is upside for both. We like Marvell on the custom chip side. They help companies like Amazon and Microsoft bring chips to market. Broadcom is another one. We disclose all of our holdings on our website, by the way, so for your viewers' knowledge. But basically, the custom chip opportunities is one of the more interesting ones going into the next 2 to 3 years.
And Ivana, real quick before I let you go, just the rhetoric coming out of the White House, the tit for tat that we've already started to see play out between the U.S. and China. Obviously, tech very much, chip makers front and center in that. How big of a risk do you see that posing, more broadly speaking, at least in the short term?
Well, I think in the short term, we expect a lot of volatility, but in terms of actual risk is pretty limited. And this is because really this upside is driven by demand. So we see demand in the US, we see demand globally. So as long as there is demand, there is going to be upside for the stocks. And really these headlines will be more of a volatility causers rather than actual fundamental downside. Long term, if NVIDIA is not able to sell to the Chinese market, we think that that is a negative, right? So that will cap how big the ultimate opportunity is. But in the short term, there is a lot of demand, and I think even without the Chinese markets, there is more demand than supply.
What does that
available.
longer term downside risk then look like?
Well, it's really more that they will be shut down of a even bigger opportunity that they could have had, let's say, 5 years plus out, but that's still to be developed, right? Like if lower end chips are allowed in China and NVIDIA can access that market that way, there would be still some of that potential left for the stock.
Okay. Ivana, thanks so much.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.